All right, good afternoon, everybody. Welcome to today's webinar. As we do every week at 12 o'clock, we're going to be bringing you 30-minute business insights on the topic of today. Today, we're going to be joined by Mark Borda, who's going to be talking about preparing your business for sale, a little bit about quality of earnings and due diligence in this post-COVID world. A couple of quick admin items before we get started. There's a Q&A window at the bottom of your screen. You should feel free to use that to submit questions as we go. Some of those questions we might answer during the course of the discussion today, and we will hold some time at the end to answer any remaining questions and any that come up during the presentation as well. The chat will be turned off for this, so if you want to talk about something, definitely submit it through Q&A. We look forward to answering all your questions. Secondly, please sign up for our email list. Some of you may have received today's invite in one of our scheduled emails, and some of you may have had it forwarded to you or found it on our website. I encourage you to visit our website, sign up for the list, and make sure you get invites for all of our weekly TRU Snacks Sessions. We go live every Thursday at 12 o'clock for just 30 minutes out of your lunchtime for relevant, timely topics for you and your business. And with that, I'd like to turn it over to Mark Borda. Mark's a director in our transaction advisory practice, and he's going to be walking us through today's content. So, Mark, over to you.
All right, great. Thanks, Steve, for the intro there. And thank you to everyone for joining today. All right, the agenda slide. So for the next 20 minutes or so, we're going to touch on the current M&A environment and our thoughts on the rest of 2021. And then we'll discuss several ways to prepare when selling a business, as well as the benefits of engaging in a sell-side due diligence engagement when selling your business. So, okay, let's jump into it. Can you move ahead one more? First here, we're going to talk a little bit about the M&A environment. So where are we now? In 2020, deal value in North America was at its second lowest level since 2015. And, obviously activity and therefore deal value was lower primarily due to COVID-19 pandemic, bringing the vast majority of all the deal making during the second quarter of 2020 to a virtual standstill. And then starting in the midsummer, activity started returning, on the back of, increased confidence and just several macro related tailwinds, such as, monetary intervention to primarily, keep liquidity in the system and keep rates lower, fiscal intervention, and we started seeing more talk and an increase in confidence in the efficacy of potential vaccines in the future, once approved by the FDA. And that pickup in momentum really increased into a strong fourth quarter of 2020 for deal making. And that was, attributable to a number of things, primarily just the reemergence of paused deals that were put on pause during the summer, the pandemic, pent-up demand from buyers. There's a lot of urgency from sellers to try to close deals during the fourth quarter of 2020 to get ahead of any potential, Biden administration tax legislation. And also, there was just continued distressed opportunities in the marketplace. I'll also say you saw a really strong rebound in the public markets, which I think provided a lot of confidence in the private markets. And thinking about so far here in the first, month and a half or so of 2021, that activity, that the strength in that activity in the fourth quarter, certainly is continuing here. We're seeing a lot of activity in, certain resilient sectors like technology. We're also seeing a lot of activity in healthcare as well. And one byproduct of the pandemic, which we're really seeing play out, is the accelerated activity from both the haves and the have-nots. So, companies that have experienced financial or operational hardship due to the pandemic, they're seeking to partner for, either necessary capital or operational know-how from, an outside provider. While on the other hand, you have, companies that were favorably impacted by the pandemic. They're finding themselves in very high demand, and they're finding that now is a favorable time to transact. Like for example, healthcare companies that have exposure to home care or telehealth, even behavioral health. So they're seeing an acceleration of structural industry trends that were already moving prior to the pandemic. So as far as our thoughts on the rest of 2021 and also 2022, frankly, we think that the strong trends that we're seeing here in the first month and a half or so, 2021, continue. And we think it continues because of the vast amount of capital available for acquisitions, as well as the favorable credit conditions, to achieve those acquisitions. And there's also other, macro-related tailwinds that we think will help, like the improving COVID situation and the impact that has on the broader economy. And other, just your general increase in confidence from, the business and consumer marketplaces as well. The largest risk, I think remains COVID. I think specifically how, companies are adjusting to the environment, how companies are pivoting their go-to-market strategies, or how they're pivoting their general business operations in the current environment. And it's interesting, like in addition to M&A, there's been a lot of work, to do with a lot of our clients' businesses or their portfolio companies. We've been speaking with a number of clients about assisting them with, performance improvement engagements, liquidity analysis, cash flow projections, and, other value enhancing activities that, work in conjunction with, an acquisition strategy. So here we're going to talk a little bit about, a couple important considerations when selling your business. And this is whether, you're considering selling your business, or if you've already made the decision to sell your business, or even if you think you may sell your business over the next 5 or 10 years or so. It's important that you start preparing your business for the process. And the earlier you start, the easier and more effective the preparation will be. Preparing, puts you in the position to, more effectively exit or take on a capital partner on your own terms. And it also allows you to have, better flexibility through the process, better leverage, and, ultimately, better negotiating power, through the transaction process. Trying to market a business before it's ready potentially creates, quality of information issues or other red flags that are really difficult to mitigate during the sales process. So, a couple actions to consider when preparing yourself for a sale. First one, determine the likely value range in which your company's worth. Knowing this arms you with the knowledge that, if that value does not allow you to achieve your, your personal or business objectives post-close, then you're not ready to go to market. And, I work closely with our valuation practice in this regard at Citrin Cooperman. We look at, we help clients in this aspect, by looking at recent acquisitions in the same space. We also determine value by discounting cash flows, and other methodologies, which all depend on, the specific company and its specific circumstances, as well as, the industry in which it operates. You also want to, and this is obvious, but you also want to, work to increase the business's value. Of course, you want to drive sales and margins higher, but while you're doing that, you also want to make sure that you're, like I said, avoiding any potential quality of information issues or, other red flags down the line when you do go to process. You effectively want to make sure that your financial house is in order, because by avoiding these issues, you're essentially increasing the likelihood of a deal getting done once you're in process, as well as supporting the maximum value that the market's willing to bear for a company or industry at the time. And some specific examples, to think about is, working to increase the detail of financial reporting, and particularly anything that gives the buyer more insight and allows them to better understand your business and the trends of your business. So, sales and gross profit reports are incredibly helpful to a buyer to see, to understand, the business and how the business is trending. So, being able to generate sales and gross profit by, customer, by product, by geographic location, those are all incredibly helpful. Cleaning up accounts receivable and accounts payable. Make sure you have policies in place that are effective in collecting receivables and identifying and writing off bad receivables. Just updating your general accounting policies and procedures so that they're clear to a reader. If possible, construct projections that show where the business is going, with realistic and supportable assumptions. Even things as far as, just making sure your internal financials reconcile to the tax returns, or consider having, a third-party accountant come in and, perform a review or a compilation or an audit. All of those are incredibly helpful as well. And then there's also, I also want to touch on the operation side as well. There's things that you can do in preparation of a process, like, considering your sales pipeline and what does that look like, and will a buyer, feel like they need to buy new equipment or hire additional workers or revamp production day one. Is there an effective sales and marketing process? Is there a process whereby leads are generated and converted into sales so that a buyer doesn't have to feel like that's something that they need to construct and implement day one? And one other thing I'd also add is, if the owner of a business plans to exit completely, you want to work to make sure that you're taking steps to ensure the business can support its value without the owner. So you want to make sure that the business doesn't fully require the owner's presence to maintain and increase cash flows. So those are all, certainly important as well. All right, so here we're going to talk a little bit about the benefits of engaging a third-party accountant in a sell-side due diligence, engagement with selling your business. We're seeing a meaningful pickup in sell-side due diligence engagements, as I've had many investment bankers and M&A attorneys reaching out to me and my colleagues to really push these for their client. They're becoming much more standard in the marketplace, where buyers are almost somewhat expecting, particularly if there's a good amount of complexity with the selling business. And it creates a lot of value. These sell-side due diligence engagements create a lot of value for, primarily for the seller, but also for the buyer. And the buyers find these incredibly beneficial because it provides them, with a deep understanding of the target business in advance of its own, due diligence process. It also helps streamline the process for the buyer, which shrinks the timeline, which is great for everybody. And gives buyers some comfort, just general comfort, that another third-party accounting firm has analyzed the business. And then, of course, on for the sellers of the business, it provides further credibility to their financial statements and business operations in the eyes of the buyer. Like I previously mentioned elsewhere, it also increases the likelihood of ultimately reaching a deal, because in a sell-side due diligence engagement, potential red flags are identified prior to buyers conducting their due diligence, which mitigates surprises and allows the seller to address that those potential red flags prior to a buyer identifying and asking about it. The sell-side due diligence engagements also help sellers establish strong business propositions with defensible EBITDA, and we'll talk a little bit about some of the key components of the sell-side due diligence engagements, like the quality of earnings report in a minute here. But the last thing I'll say is that it also allows the selling management team to focus on the ongoing operation of the business as much as possible during the transaction process, because during a sell-side due diligence engagement, we're handling a lot of the questions from the buyer or the buyer's advisors, and we're able to take a lot of that burden off the selling company's management team. Key aspects, I'll talk a little bit about some key aspects of the sell-side due diligence engagement. So there's the quality of earnings report, of course. As businesses are often, they're assessed and ultimately valued based on a multiple of EBITDA. A sell-side quality of earnings report, determines a company's sustainable EBITDA during the prior several years. We're determining that by adjusting a selling company's historical reported EBITDA for certain items, such as lost income or inconsistent application of accounting policies, which affected the financial results from one period to another in the historical reported financials. Large one-time expenses that are non-recurring in nature, or expenses that are non-operational in nature. I mean, there's a lot of adjustments, but those are just a couple examples. We also analyze net working capital, and in a typical deal, both sides of a potential transaction will negotiate a normalized amount of working capital, which is to be delivered by the seller to the buyer at close. And in a sell-side due diligence engagement, we're providing insight into monthly working capital accounts that are meaningful to understand when negotiating what the normalized level of working capital actually is. So, for example, we'll look at revenue trends, we'll look at general industry conditions, as well as, the identification of working capital accounts that are not considered normal, and for that normal or operational in nature, and for that reason, it should not be included in the amount of working capital delivered from the seller to the buyer at close. Right. We also look at, we also focus on qualitative analysis components as well. So in a sell-side due diligence engagement, we're also providing key findings that are of particular interest to a potential acquirer, such as the accounting policies and practices utilized by management, roles and responsibilities of key members of the accounting and finance department, and the consistency of those policies and key members as well. Key accounting and financial systems, and what are the softwares used, and is there any gaps between the software and any manual components in between all of them. And then in addition to that, there's also an ongoing advisory element. after the completion of the sell side due diligence engagement, we provide certain ongoing advisory services, such as, periodically updating the report and key findings, coordinating due diligence requests and interacting with a potential buyer or potential buyer's advisors, as I touched on previously. Providing tax planning services for the owner of the selling business. And we'll also provide advice and comments on other various M&A documents, such as like the purchase agreement. So between preparing for your sale, which as well as conducting sell-side due diligence engagements. I mean, those are two very, very important services that we provide our clients, and they're certainly core competencies of ours. So enlisting a qualified accounting firm to assist sellers in the preparation of their business for a sale, as well as the sell-side due diligence engagement, it effectively reduces the likelihood of critical issues arising during the process, which will contribute to a successful transaction, which is most certainly what all parties are seeking to achieve. So, and like I said, we spend a lot of time with our clients, assisting them through the entire transaction continuum, from decision through to closing and even after. So, please reach out to us. If there's anything, we can help with that we discussed today. Like I said, we perform all these services and they're core competencies of ours. Okay, so that's it for my presentation here. And thank you once again, everyone, for joining.
Great, Mark. Thanks very much. So we've got some good questions coming in here, and I'm going to start to throw some of these over to you. How do you think the current political environment, specifically uncertainty around tax policy, increasing regulations in some industries, et cetera, are going to affect volumes and pricing as we move forward into this new environment?
Well, I think I think that the urgency to transact is still there from a tax perspective, and just I don't think the Biden administration is going to be as hurtful to the business world as many think, but I know that that's a general thought process out there. So I think that is going to create a lot of urgency on the selling side, where business owners are going to accelerate their businesses to market, hopefully not before they're ready. And I think because of that, I think if the market is flooded with a lot of these owners that feel this level of urgency, then it may not be as beneficial to pricing as the sellers would like. It's a really interesting dynamic coming out of the COVID summer, where M&A activity virtually shut down, and trying to flush out, whether it's truly a buyer's market or a seller's market. But if the level of urgency for sellers to get ahead of potential regulatory change or certain legislations, well then that is most likely going to have a negative impact to pricing for a seller's side.
All right, great. And we've got a question on IP-driven transactions, right? So we talked a lot about kind of the EBITDA, working capital calculations, other earnings prove-outs during the Q of E. What about companies that are probably not going to sell on EBITDA and are probably going to sell because of the value of their IP or something of that nature? Any thoughts on what the best way to sell those companies are and how it might change the transaction process?
No, I mean, it's still, if a company like that is not acquired based on a multiple of EBITDA, it's most likely going to be based on a multiple of revenue. And if that's where if the IP is generating revenue and that's the value proposition of the business, it's the actual IP as opposed to the incremental operating leverage of a business. Well, then I think I think everything that I presented today still holds, but I think a buyer is going to look at you as a component of revenue. And if it's a particularly if it's a strategic buyer, if it's a financial buyer, which, would be interesting to see, I think that there still be an EBITDA analysis, just with the understanding that that's not the value proposition. May or may not, but there's a chance you're not showing any sort of impressive EBITDA levels. But I think that the mechanics of the situation, the whole M&A process, as well as preparing your business and the sell side due diligence engagement, I think that still holds. It's just taking a different angle of viewing the business.
And I mean, you just kind of alluded to a part of the next question too, which is, there's obviously different valuations that you're going to be looking at depending on the type of buyer coming in, what type of capital they're bringing. So might be a combination of sort of valuation and investment banker or broker answer here, Mark. But how do you advise owners on the best way to explore value ranges across those different types of buyers for their businesses without getting bogged down in a lot of different meetings?
Yeah, I think engaging in evaluation engagement. In fact, we have it's really funny, like over the last probably 2 months, particularly once we got into 2021, a lot of our clients said, hey, we want to sell, but we're not really sure what our business is worth, and we want to make sure that we have at least a range of value before we proceed to the next steps. Whether that's reaching out to potential friendly buyers or opening it up to a broader sales process. So I think that the first step is engaging in a evaluation of your business, and then using that information to effectively help support your next step.
Great. And then last question for today, Mark. Specific to services businesses, any thoughts on the sorts of ballpark ranges that services businesses are currently looking at for EBITDA multiple?
A huge range. I mean, it all depends on the actual services provided and and their end markets. I mean, we've seen everything from 7 to just under 20 times. I mean, it's all depends, and it depends on, like I said, it depends on the actual services provided, the end market, and who the buyer really is. So, that's a tough one because it's just, particularly for business services, it's just a really broad range.
Great. All right, Mark, thank you so much for joining us today. Really appreciate the insight. We've got Mark's contact information up on the screen right now. Please feel free to reach out to him with any additional questions. To have a call to discuss some thoughts or have a little bit of an expanded dialogue. We're here for our expertise. We're here to provide you with the answers that you want. So don't hesitate to reach out to Mark with anything additional. To close out today, we've got 2 last items. The first is our weekly snack basket giveaway. Today, that drawing is going to go to Gary White of Reason Research. Congratulations, Gary. We'll have somebody reaching out to you to get shipping information on where to send that curated basket of snacks. Hope you enjoy. For our next sessions coming up next week, we got a hooray from Gary there. It's very exciting, Gary. We hope you enjoy them. Next week, the 25th, we are going to be hosting Rob Brown from Apexium Wealth on the fundamentals of personal wealth. The 4th of March, we're going to be talking about how to automate the finance function using accounting robots. That's going to be Carlos Catalan out of our strategy and transformation practice with our partner Plenidata. Going to show you some videos on bots and walk through what the value proposition could be. On the 11th of March, we're going to have a state and local tax overview, specifically with managing a remote workforce with Eugene Revere out of our SALT practice. And on March 18th, we're going to be joined by David Lewis, the CEO of Operations Inc. He'll join me for a conversation on questions around opening and managing a workplace in a post-COVID world. There's a lot of HR complexities there, and David is the guy to talk to us about it. So hope to see you on those future sessions. I wanted to thank you once again for joining us today. Appreciate your questions. We're here every Thursday at 12 o'clock. Sign up for our mailing list. And we look forward to seeing you on future broadcasts. Enjoy the weekend. We'll talk to you soon. Thanks.